Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day. In this video, I'm going to walk you through the process of valuing restaurant group stock by analyzing their financial statements and dissecting their financial ratios, so we can determine if it's a buy or a sell. The Restaurant Group is a UK company. It was formed in 1987 as City Centre Restaurants with the objective of owning and managing the Garfunkel's restaurant chain. In the late 80s, the company bought the Mexican food chain Chi-Chi's and renamed it Chiquito. In 2004, the company changed its name to the Restaurant Group. During the COVID pandemic, it permanently closed 230 restaurants. Let's get started with the model. This is a small cap company, £360 million market cap. They're trading at below £1, 61 pence. And they have 590 million shares outstanding. All the numbers in this video are in British pounds, since the company trades on the London Stock Exchange. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. The company had £41 million of free cash flow in 2017, but it's been getting worse and worse each year. It's negative £48 million in the trailing 12 months. Net income is the profit and loss for the company. It's revenue minus expenses. That has also been getting worse each year, from positive $33 million to negative $169 million. Revenue is the sales for the company, and that did grow a lot from 2017 to 2019. But dropped a lot in the trailing 12 months due to COVID. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. And the difference between those two numbers is their gross profit. And that was negative in the trailing 12 months. Below that is operating expenses. Then below that is operating income, which was negative in the trailing 12 months and 2019. Below operating income is the interest they pay on their debt, and then there's pre-tax income, then taxes. So the bottom line of the income statement is their net income. That's their accounting profit or loss. And they had a big negative in the trailing 12 months. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. Then there's capital expenditures, which are investments in property, plant, and equipment. Operating cash flow minus CapEx gives you your free cash flow, and that was negative in the trailing 12 months and 2019. Since the company had so much negative free cash flow, it issued £55 million of stock in 2020 and $126 million of debt. Let's look at a capital structure. $402 million of equity, $344 million of debt. They're 54% equity, 46% debt. And their WACC is about 13.5%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year that's $574 million. We discounted those numbers back to today's in the weighted average cost of capital. We get a value of the company of £394 million. We divide that by 590 million shares, and we get a calculated stock price of 67 pence. They're trading at 61 pence, so they're trading at a 9% discount. It's a buy, but it's really close. Simply Wall Street values the company at 88 pence, so they're saying it's a little more undervalued than me. So it's hard to estimate future free cash flows when there's negatives in the past. So I had to use analyst estimates for my future expectations. And of course, nobody can predict the future. I'm just using the information from the past to try to predict the future, but anything can happen. This company can do really well and its stock price could go up to £10. It could do really terrible and go bankrupt next year. Only time will tell. The stock price peaked at about £4 back in 2016, but it's been coming down little by little every year. It's really hard to predict if this stock price will get back to where it was before. It really depends on how well the company does in 2021. If they can generate positive free cash flow. The COVID pandemic is killing restaurant businesses. This company has a really high beta, 2.3, so the stock moves more than 2 times the market. The stock has gone down 50% in the past 52 weeks, much worse than the S&P 500, which went up 18% in the same time frame. The low was 20 pence, the high was 140 pence, and the stock is trading higher than its 200-day moving average, but lower than its 50-day moving average. About 2.5 to 3 million shares are traded each day for this stock, and of the 590 million shares outstanding, 533 million are on float, and 91% of the shares are held by institutions, so they're really bullish on this stock. Columbia Management Investment Advisors owns 19% of the stock, FMR owns 7.5%, then Royal London Asset Management, then Schroeder Investment, then Aberforth Partners owns 4.8%. Let's look at the financial ratios. The average PE in the market's 11.4, the median is 14.4. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They have negative net income, so they have negative PE. Price to sales is stock price over sales per share. They're at 0.5, so investors are paying 50 cents for $1 revenue. Price to book is stock price over book value per share. They're at 0.9. And the way you calculate book value per share, it's equity over shares outstanding. Equity is assets minus liabilities on the balance sheet, and they have 400 million pounds of equity. They have negative 215 million pounds of tangible equity because they have 617 million of intangibles on their balance sheet, 357 million of goodwill, and 260 million of other. Interest coverage ratio is EBIT over interest expense. They have negative EBIT, so they have negative interest coverage ratio. ROE is net income over equity, negative net income, negative ROE. Current ratio is current assets over current liabilities. They cannot cover their current liabilities with their current assets. Their current assets are 50 million of cash, 9 million of inventory, and 26 million of prepaid assets. So it does look like they're going to need more debt or equity to run their business over the next 12 months because they had negative free cash flow, plus they have negative 112 million of working capital. The best way to look at ratios to compare them to similar companies, I've done videos of 12 companies in the same industry as the restaurant group. And if RTN has a number in red, they're worse than the average. If they have a number in green, they're better than the average. So they're worse in PE because they're negative. The average in this industry is positive 22. They do have a much better price to sales ratio of 0.5 and also a better price to book. A really bad current ratio at 0.5. Plus, they don't have as much access to funding as a larger company does. So this could be a problem if they can't get their current ratio above 1. They have a terrible ROE. They are lower in debt than average. And they're a really small company. 360 million pounds. I converted all these numbers to British pounds. A lot of companies in this industry do not pay a dividend similar to them. So to summarize, I do have them trading at a 9% discount only because their stock price has come down so much. That doesn't mean it can't come down lower. I ranked their free cash flow 3 out of 10. It was pretty low in 2017 and 18, and now it's negative. I ranked their revenue 4 out of 10 because that's come down a lot in the trailing 12 months. And I ranked their ratios 3 out of 10 because they're pretty weak. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking the link in the description below. Thanks for watching.